silver is no stranger to volatility at all. It's a smaller market, or it's quite deep in its own right, but it's a much smaller market than gold. And what you will tend to find is that when there's a change in trend, it doesn't matter whether it's into a bullish phase or a bearish phase, silver will always move by a greater degree than gold does. So generally speaking, as a rule of thumb, if gold moves either up or down by X%, let's say, then silver will typically move by 2x or even 2.5x, and sometimes a lot more than that. So what we had last Friday particularly, and then carried through into Asian hours over the weekend, was, as you say, a massive unwinding of what had been a vastly overstretched move, certainly in silver and to a lesser extent in gold. Now, for years, I've always referred to silver as a Cinderella metal, although within the last few weeks I've actually been using the term Icarus because it's been flying too high. And the analogy there is that when silver does rally and comes to the ball after the fairy godmother, usually in the shape of the gold price, has said that you shall go to the ball, when she leaves at midnight, she leaves very much more quickly than she arrives. And it happens time after time after time with silver rallies. It can be a very dangerous metal to trade. Its historical association with gold leads some observers to regard silver as a safe haven. I actually don't think it's that at all. I think it's more of a death trap, to be perfectly frank.
OK, so there's a risk. How much risk premium is priced into silver then?
Too much. It's a very difficult metal to which to ascribe a cost of production in the same way that you could with copper, for example, because less than 30% of silver mine production is actually from primary silver mines where you can obviously allocate a cost. The balance comes as a byproduct from lead, zinc, copper or gold mines. So silver's supply side is a function of the business models for the base metals predominantly, as opposed to its fundamentals in its own right. So price action is almost exclusively driven by the existence or lack thereof of demand for the metal. So that's one of the reasons why it gets tied to gold. So you can't actually say that pull a number out of the air, at $30 per ounce, it's got a good floor, or at 120 it's got a good ceiling. It dances to its own tune. So from my point of view, as a fundamental analyst, when we get to these kind of rarefied levels, that's where you have to start turning to our technical colleagues for guidance and looking at simple parameters such as moving averages, for example, or the RSI, and looking at the Fibonacci retracements, which is one of the more reliable elements. Both gold and silver actually unwound the 61.8% retracement level over the course of Friday and Monday, going back to where these steep rallies started. So up towards, we're looking back up at about just coming up towards $90 per ounce for silver and just shy of 5,000 for gold. All the different geopolitical elements that have been supporting gold are still in play, with the one key exception, which I believe was actually the trigger for the unwinding last week, which was the president's announcement of Kevin Walsh as his nominee. Frankly, he could have named anybody. It really wouldn't have made any difference. The key here was that one important area of uncertainty was taken out of that supportive matrix, and that I believe was what started the headlong falls end of last week.